Now, I've always wanted to do this. I've always wanted to put a guy in a skirt hoovering on the front page of my presentation. And at long last, Mr. Draghi has given me the excuse to do that. I've kept him a little bit vague in the background because I didn't want to scare you this early in the morning. But there is actually a reason for me doing this. My comparison of CSPP, ECB, QE, and the credit markets is basically they're hoovering everything up that's available to them. That's one aspect. The other aspect is credit spreads are so squeezed and so tight that credit feels like it wants to break free. So that's why this song is also the best single comparison that I could think of. I have a number of themes for today, and one of them is that hoovering. I will talk briefly about CSPP, but not too long. I get into trouble from time to time when I spend too much time on CSPP. And I will also talk about steepening, a little bit about hybrids, a little bit about reverse Yankees, and about our view on credit markets. But I cover each topic very briefly. Now I have the time running down there, so that's perfect. And I'll make sure I stick to my time because my esteemed colleague Fernando is coming in after me. So these are the topics that I'll be looking at. And firstly, the slow widening trend. Now, I realize there's too much on this slide, but I tend to talk more than go through point by point. Well, what's happening in credit markets at the moment? Yes, very conducive primary markets. Spreads extremely tight. But there are some worrying signals further along the field. Tapering, obviously, is around the corner. And your estimation of that is extremely important in certain aspects. Because Sintra really showed that the market can get spoofed, can get spooked by this, can get a little bit edgy. And it could lead to certain violent spread movements. Leverage in the US continues to be on the rise substantially, not filtering through into any form of default rate rises yet, or significantly so. We're starting to see CDOs coming back. The bearish sentiment is also being seen that for the first time we're seeing positioning in some of the main CDS indices being more bearish than bullish. High yield inflows are starting, particularly in the US, to be very sketchy. And also in Europe, it's a hit or miss situation on that side. And we've got to remember valuation is extremely tight, particularly when we look at Europe. I always thought one of the best graphs I've seen in the recent past is the one showing US treasuries trading at the same level as European high yield in terms of yield. That's an indication of how tight we are currently. Credit has started to widen a little. We are coming off the lower levels of spreads. Early August saw a little bit of a reverse, and it's been a relatively wide-held situation. There's also a curve repositioning trade ongoing. Where is the value in the curve, in my estimation, and more about that later, is particularly on the short end of the curve, because that's where credit spreads are cosmetically wide. Now, for corporate issuers, that would say, hey, therefore we need to target the long end. For me, that's an indication that credit curves could well start to steepen from where we are at this particular point in time. But there are some positives. European growth, what's it meant for European leverage? European leverage is actually on its way down. What does that mean? Perhaps more liquidity available for even more tenders, ongoing tenders. Again, that would benefit the short end of the curve and therefore lead into that steepening theme. Tapering is still with us for a long, long time. QE is still going to be with us for a long time. And whether the ECB or CSPP buys 1.7 billion like last week in secondary credit, or they're buying 400 million, they're still going to be the major buyer. and they're still going to be influencing a market that's extremely illiquid. They're going to keep the lid on any massive spread widening. But the trend has been set. Valuations are too low, and credit markets, in our opinion, will start to head upwards slowly. 2018 is also a year that we see more net supply. Why more net supply? Higher positive net supply, particularly due to the financials. Less and less financials rolling off the curve, or bank debt rolling off the curve in 2018. That's what's indicated on this graph on the right-hand side. The orange is corporate investment grade issuance in euros. Corporate high yield is one of the grays. And our expectations for 2018. What I've just done is kept our forecast relatively same to 2017 for the time being, and I've inserted the redemptions and taken that away and CSP purchases. And what do you see? Despite CSP purchases and all the redemptions out, we're looking at over 200 billion in positive net supply in 2018. That's going to be quite a bit for the credit market to take down. The spot you see in the middle there is where we believe that net supply will end up in 2017. At the moment, the blue line is at a very, very low level, but that's because all the redemptions, etc., have been factored in, but not all the supply yet in 2017 has come to the market. So, we do believe that this also will have an influence and will indicate that that slow widening trend that we've started to see from early August is with us. And one of the main themes for that, in our opinion, will be steepening. Graph here shows excess returns over swap by segment in the credit market. And I've ordered them by duration. So the shortest segment is double B high yield on the left and 3 to 5 years in CoCos and peripheral financials all the way on the left. And then on the right, you see three categories: telecom, 7 to 10 years, a long-dated paper. And I've added an orange bar there because that's where total return stood at the beginning of August. And you see that the light gray bar next to it is where we stand currently. That's how much excess return has already been taken off the table in the last few weeks or so. So that move is already ongoing. We believe that credit spreads will contract less in the short end. Why will they contract less in the short end, or widen less in the short end? Because of this particular phenomenon. I've taken telecom curves here. You see that most telecom curves trade above zero in terms of yield, but the credit spread relative to the swap line that's also in there is fairly high as a consequence, because the short end is cosmetically wide in terms of spread, because credit has a difficulty going into negative yield. And why should a Telecom Italia, for example, trade into negative yield? But that means when there is a backup in rates, that we do believe, therefore, that the insulation is best on the short end. And if you're looking at new issue books these days, it's not always easy to go really long down the curve. You see more large tranches on the short end of the curve. And this is part of that positioning play that investors are putting on at this point in time. Another factor that will influence this short end play is, as I mentioned, we do expect more supply to be targeted towards the long end. Also due to these tenders, buying back the short end and replacing with longer dated debt. But also because if you look at European companies, USD funding quite often is cheaper for them on the short end of the curve, but not on the long end of the curve. So they will target, they will also use that particular currency mix in making their decisions, meaning that supply on the long end of the European curve will still be relatively heavy, also from non-European issuers. I get to talk a little bit about CSPP. And the thing is here, I'm conscious of time, CSPP, what are they actually doing? What are they buying? What are they buying in credit markets? Well, the target is liquidity. The gray bar at the top is what they've bought in terms of number of names against the outstanding size of the bonds. So if a bond is billion or larger, they've bought a larger amount of those. Likewise for 500 million plus. But then if you look at the very small transactions that are eligible, 250 million and also less than 500 million, they haven't bought those. They're targeting liquidity. They have to. They're buying 1.7 billion a week in occasion in the secondary market where there is no liquidity. That also means that they've bought 80% of their eligible universe. And again, particularly in the larger sizes. And for the 1 billion plus, they've bought almost 90% of all the deals that are a billion plus that are eligible, they bought at least once. Now, whether they're buying 1.7 billion a week or a billion a week or 500 million a week, they're going to have to hit these ISINs again and again and again. So I might be thinking valuations are too tight. I might be fearful of a little bit of supply. Growth is coming around the corner. But real sustained widening with an ECB or a CSPP this active and hitting those same ISINs again and again and again is almost impossible. On to the Yankees. I'll put the reverse Yankees in because I think it's an important topic that we have in European markets these days. Why did all these US companies, foreign companies, target our European credit market? Why do they choose the euro instead of the dollar market on occasion? And they'll all claim the net investment hedge. We have European operations, we need to fund them. And at the same time, our swap desk still sees them swapping part of it back into dollars. That's because that arbitrage was available. Funding in euros, swapping it back to dollars, and it was cheaper funding. And that's what the orange line there indicated. Throughout 2015 and 2016, that orange line was far in excess of the cross-currency basis swap and the 3-6-month roll. So there was that opportunity. But that opportunity is gone now, and we don't expect that to come back anytime soon. Nonetheless, there's still funding in euros. So it is partially that net investment hedge. But the volume has reduced perhaps a little bit in comparison to our expectation. But the thing is it getting out of hand? Foreign issuers, 45% roughly of European issuers these days. But it's a relatively steady picture over the last 3 years. US issuers up to 20%, 51 billion done already this year. But is it really getting out of hand? Well, if you look at the situation between US corporates, what are they issuing in euros? What are they issuing in dollars? What they're issuing in euros is 51 billion and another 443 billion so far this year they've done in dollars. If you term that in percentages below that, what you see is they're stuck at 10% of their funding. The volume might increase year on year, but that's because their total volume is increasing. They're not actually saying, we want this European market, we are going to target them consistently all the time, and we're increasing that percentage. We're at 10%. So the situation is not out of control. My head of DCM said to me, yeah, but what about the other way around? Well, that's actually quite a boring picture. European corporates are extremely consistent. If you look at the bottom chart here, what you see is that, well, we do about 30% of our funding in dollars, full stop. And that's a very, very consistent picture. Below that, you see if a European corporate issuer was to target the US market and swap it back to euros, only the long end, the 10-year, where we see minus 5 basis points, is it actually marginally cheaper quite often to issue in dollars and swap it back. So it's usually M&A related that we do see this type of funding, but it's also a very, very consistent number. We expect the differential between dollars and euros to fall further, so that arbitrage opportunity will be gone, or is gone at the moment, and will remain closed. But the credit cycle does differ. and that's something to be careful of. European growth is around the corner, but we have a tapering story, and valuations are excessive. So the differential here actually decreases a little bit more. So dollars are also benefiting from the crowding out effect of CSPP. I always want to have something really optimistic just before I close. What happens if we get European growth ticking upwards more than people expect? We have higher M&A, higher investment levels, credit quality under pressure, higher supply. Oh, and by the way, because we have higher growth, we'll have higher rates. Excess returns, total returns under massive pressure. Exodus from ETFs, mutual funds. And we don't have liquidity in the credit market. Increasingly, CSPP continues to scale down. How are we going to absorb not just 200 billion in net supply, but 300 or 400 billion in net supply? The positioning changes. Everyone is relatively optimistically positioned for 2017, but the positioning changes quickly. No liquidity to absorb. That liquidity that the banks used to provide. The graph on the left shows the orange line shows the share held by banks of the European corporate inventory, the European corporate outstanding bonds. And it used to be 35%. We're just down below 10% already. Banks, quite simply, won't be able to provide enough liquidity. And when we have ETFs like we have on the right-hand side, constantly seeing inflows, if that reverses and they are directly redeemable, so the liquidity buffers are small, there's nobody to absorb the pain. So if there is an unexpected event, like we saw late 2015, early 2016, we had that type of liquidity squeeze. Oil prices faltering, global outlook was very bad, but credit spreads in Europe, also investment grade and particularly high beta, were under massive pressure, more than they should have been, and that's due to the liquidity squeeze. Not our central case scenario, but something to watch out for. Last thing I'd like to leave you with, a favorite topic that every credit strategist always has, hybrids. And I was glad to see that this conference was sponsored by Moody's, and I nicked a little car at the back and put it into my bag, because I wouldn't have dared to have done that to S&P, because they're not always my favorite agency in this regard. I think they're one of the major reasons why there is a lot of hesitancy in terms of funding in corporate hybrids. They've made a few mistakes or judgment errors, changed their minds a few times. I think on Veolia, Total and RWE was backroom politics. Total, they got completely wrong of Veolia removing the equity credit on the basis of an earnings call. It's very erratic, and it's left issuers with the question, whatever next? It's good for the secondary performance because there's almost a scarcity factor, particularly with the whole market looking for yield. So it's a very attractive market to fund into if you're still fond of the product. Now, there's more challenges. And unfortunately, my last slide is not the clearest one, but there's more challenges, and particularly the one at the top, IFRS. A lot of the corporate hybrids are accounted for as equity. They might need to be moved into debt in 3 to 5 years' time. For us, it's another reason to stick to low beta or to high beta, low duration in corporate hybrids. But it's something to watch out for. So it's been the rating agencies, it's been the tax authorities, and now we've got the accountants targeting corporate hybrids. Not always easy. But it still provides a purpose in the current credit markets. To summarize, I have exactly 19 seconds left. A slow widening trend. Hoovering is still going on, but the credit market does want to break free. And Freddie can't do all the hoovering, and nor can CSPP. Thank you very much.